Hi, everyone. This is Josh over at Azzad. We're going to get started in just a moment here. And before we do that, I'm going to point out that this webinar is being recorded. So please be aware of that. And we'll try to have a copy up on our social media and the AzzadFunds.com website shortly, i.e. within the next 24 hours or so. However, we encourage you to stay on because you'll have an opportunity to ask questions of our presenter at the end of the presentation. And if there are questions that are of a timely nature as something is being presented, we will have the option to take those, and I'll pitch those to Christian as we move forward. Also, a note to those who are here for continuing education credit from the CFP board, note that you need to stay on for the entire webinar in order to receive credit. We get a report that monitors attendance, and we need to verify that before we communicate your information along to them. So be aware that you need to stay on for the entire webinar today, and we'll be sending along a confirmation of your attendance following that. So with that, let's go ahead and get started. And I want to thank everybody, first of all, for taking the time to attend Azzad Asset Management's 2020 Investment Outlook webinar. Again, this is Josh Brockwell over here at Azzad. I'm Investment Communications Director. So as we had talked about in the promotional material at the outset, financial stock markets hit multiple highs throughout 2019, and we have some of the best returns in recent years. So with that, investors are starting to wonder if markets are ready for a return to normal. I know it's a conversation that we've had here at the office and with others. So no one really knows how long the bull market's going to continue, but what we do know is the markets can't go up forever. So the question we're hoping to answer today, or one of them, is what investors should expect for 2020. So in order to do that, we are pleased to welcome in Christian Greiner, CFA, who's the Azzad Ethical Fund portfolio manager. He's going to be discussing with us trends and opportunities in the new year. So with that, we'll go ahead and get started. I'll turn it over to Christian, who is the Vice President at Zico Capital Management and portfolio of the Azzad Ethical Fund. He's joining us today from Chicago to offer up his perspective on markets and how they might move in 2020. So, well, I'll actually, before that, give you one quick word from our sponsor. How about we move to the next slide? I would be remiss if I didn't point out some of the services that Azzad provides for clients. So you'll see some of those on your screen, from financial planning to halal investment products like the Azzad Ethical Fund. We're a one-stop shop for your financial needs, and we're, of course, happy to provide more information for you at the conclusion of today's presentation during that Q&A session and beyond. So with that, I will now turn things over to Christian Greiner, joining us today from Chicago. Take it away, Christian.
Well, hello, Josh. Greetings from a nice and gloomy, overcast Chicago here in January. As long as we don't have a foot of snow on the ground, we are happy. So we're going to start this presentation. We usually, do one of these for several years now. We take a look at how the prior year went. And really, one thing that sort of struck me when we were making these slides was what a difference a year makes. When we did this a year ago, we were just coming out of that really volatile fourth quarter of 2018, and the market was looking to really climb that proverbial wall of worry that they say that market returns have to do for years like what we're having here. So the S&P returned, the S&P 500 returned 31.5% when accounting for dividends last year. That was its best year since 2013, and then really 1997 before that. So it took a look at the relatively gloomy backdrop that we came into. That dissipated, and as we went in with a little bit better economic data and a monetary backdrop, it really took off here. It was another strong year for growth stocks. They outperformed value as defined by the Russell indices by nearly 10%. Over the last burst of this growth super cycle that started in 2006, we've really had this sort of cycle within a cycle over the last 3 years. And those last 3 years have seen growth outperform by 43%. Large cap also outperformed small for the third straight year. And we'll go a little bit into what that means further along in the webinar. On a sector basis, tech, information technology within the S&P 500 returned 50% for the year. And that's a number that really catches some eyes here. And the relatively new communication services sector. Think of that as names like Google and Facebook that were taken out of tech, Netflix, a bunch of media stocks, as well as old-fashioned telecoms. That's the new communication services sector that S&P put together. Those returned almost 33%. Energy returned just 11% and underperformed the broader market by 82%. Healthcare also underperformed, just returning 20.8%, which in normal situations is a pretty good year. But going back to energy, this last half of the decade, underperforming the broader market by 82%, that's really something that's caught some eyes of some market participants. And it's sort of been an in vogue pick this year for those sectors that are going to outperform. International markets once again lagged the U.S. in dollar terms, but they still returned a relatively healthy 22.4% for the developed world and 18.6% for the emerging market index. But this is also another area that has sort of lagged the U.S. over the last 3 or 4 years. So when we look out a bit farther here, let's take a look at what the decade looked like in terms of market returns. And what we have here on this slide is market annualized price returns by the decade. And we talked a lot about, the first part of the 2000s as being the lost decade for stocks because there was a negative annualized return, and we were used to those returns that we got in the go-go 80s and as well as the tech-fueled boomed 90s. We got a little bit of a return to that environment in the 2010s. So coming off of the throes of the great financial crisis, when we started this decade, earnings growth averaged 11% a year per annum. Revenues rose 3.9%. Margins expanded. Companies bought back their own stocks, and PE ratios rose as investors became comfortable with that steady, but really not spectacular economic growth, as well as the low interest rates that made stocks a relatively attractive asset class throughout most of the decade. So if you throw in dividends into this equation, the S&P 500 actually averaged about a 13.6% total return over each year over the decade. And that's with about a 2% dividend yield. So when we take a look at what drove returns in 2019, there's a lot of ways that you can parse it. People, of course, like to take a look at it as growth to value. Did we take a look at it in terms of sectors? But we can also say, did earnings go up or did multiples expand? And how does that sort of play into the total price return of what we saw of the market here? So what we saw here in 2019 was what we would call really a reflation of market multiples. So earnings growth faltered from the pace that we saw over the last couple of years. A lot of that had to do with stimulation from the Tax Cuts and Jobs Act of 2017. We saw earnings estimates rise and the actual earnings go up. And so we see that in the EPS growth here in 2018 as multiples actually contracted. PE multiples went down that year, especially in the fourth quarter as we sort of hit a rough part in the market. What we saw in 2019 was sort of the opposite of that. EPS estimates started out strong and sort of petered down as the year went along. And we only saw about EPS growth of maybe 1%, depending on how fourth quarter goes here. We're starting to get those returns in now. And multiples, on the other hand, expanded by over 25%, PE multiples. So that's what gives us this total price return. So one could argue that 2019, in some ways, was just undoing the damage to the market multiples that we saw in 2018. And when we take a look at 2013 on this, it was sort of a similar year. You had that strong total price return, but a lot of that came out of multiple expansion. And as we can see in 2014, that was a positive year for the market as well. So we start taking a look at some of those parallels to types of returns that we saw in 2013 and going forward. So let's take a look at really where the market multiples currently reside after that reflation versus long-term historical averages here. We have a number of market multiples that participants and portfolio managers like to take a look at here to say where we are within the market cycle. And as you can see from there, a lot of these are trading above the historical averages here, the 25-year historical average, which of course still includes the tech bubble. The price to earnings ratio on expected earnings rose from 14.5 at the end of 2018 to 18.2 in just a year. That's quite a strong move. And price to cash flow also increased by a marked amount. One thing that we also take a look at here is the Shiller's PE, which is a sort of a 10-year adjusted PE when we take a look at the entire profit cycle versus where the market valuation is. And while it started out overvalued at the end of 2018, it was really the only overvalued measure that we saw at the time. It got a little bit higher here in 2019 as well. So this is probably a good time as any to remind some listeners that the market can continue to move higher for really a good stretch of time with higher than average valuation metrics here. So once again, you think about the tech bubble, tech rally 20 years ago. PEs were high for years at a time and continued to move higher. Sort of serves as an illustration of the negative sentiment that was baked into the market at this time last year in 2018. And we'll take a look in a little while about what this might mean on a long-term basis when the market gets above these 25-year averages, especially on the Shiller PE. The final measure to note here, and the only one that is really showing as undervalued, is the earnings yield of the S&P 500 subtracting the average yield of debt on a BAA-rated company. And that really measures the attractiveness of equity market versus debt markets. Remember, fixed income is still considered by some to be richly valued. Just like last year, the stock market seems relatively inexpensive on that measure.
Hey, Christian, this is Josh. Let me jump in real quick and ask you a question about the above average valuation metrics. I mean, you invoked the tech bubble of 20 years ago. I don't think that you're saying that we're in some sort of asset bubble at this point. But I mean, can you explain just to assuage some of the concerns of folks who are listening to hear that word bubble? Could you speak to that maybe very quickly before we move to that next slide?
Yes. So as we can see here on that particular slide, that these valuations are just above the averages, and these are no means the high valuations that we usually see at a market top. A market top usually has something what you would call sort of a blow-off top, where you see those valuations, those multiples, reach much higher levels than that. And when we take a look at a long-term chart of, say, S&P 500 PE multiples, you can see that while we are above it, it is nowhere near market peaks that we've seen in the past.
Okay, thanks. That clears it up.
So that goes really to our next question is, will this rally that we've seen keep going here? And one of the things that people like to say is, as goes the first 5 days of the market, first 5 trading days of the market each year, so goes the rest of the year. And we did have a relatively positive start to the year, not that 2% threshold that a lot look at forward to say, when that happens, that we usually have a positive year. But still, it was a nice positive start to it. So one thing that we do take a look at on this is what happened the next year after such a year like we had in 2019. So if one is looking for optimism, past post-World War II years show that these 2019 types of years really usually aren't the end of the rally. Indeed, more often than not, the market experiences higher than average equity returns the following year. So as we saw with 2014, a couple slides back there. So in 2013, they had 30%. In 2014, there was an 11%. We also saw, obviously, strong returns in 1998 at 27. So this makes sense, given that the belief that the markets are forward-looking mechanisms. We also have real GDP growth, and usually when we see years like this, we're still seeing some sort of strong economic growth. And because markets are forward-looking, they're seeing this and saying that these companies do deserve these higher valuations, that more profits should be coming with this higher economic activity. And as it takes a look at that stronger economic activity and earnings ahead, it starts to price that in. So on average, what we will see is that we will have an expansion of GDP growth next year of 4.6%. Right now for 2019, we're still seeing relatively, pedestrian growth at 2.2%. The average on this was 2.9%. But we could still see a deceleration of GDP growth next year. So one thing that we also highlighted last year on this call was the possibility that the Treasury yield curve would invert. And of course, under normal circumstances, long-term interest rates should be higher than short-term to compensate you for the time value of money. When investors demand higher returns for certain short-term periods, it's seen as a sign that market participants are seeing risk ahead in the coming months or coming years. And so here's the Treasury yield curve plotted out here. The dark green is what it looked like on January 6, 2020. And this is what we would call a relatively normal yield curve. There's a small hiccup in it there at the 6 month, at the 5 year, as you don't see the totally upward trending line. But overall, this is relatively normal. Now, take a look at it on May 31st, 2019. That is what the yellowish orange one is. And you can see that we do have some inversions there. You can see the short-term ones are much higher than the 10-year Treasury rate on there. And this was a big cause of concern for a lot of market observers over the spring and early summer. And normally there's really all kinds of ways to take a look at what a yield curve inversion is and what it means. The most popular one in the press to observe is the difference between the 2-year and the 10-year. And once that goes negative, that of course would be an inversion. Others still like to see if the Fed funds rate that the Federal Reserve sets, if that's above the 10-year rate. So there's a good amount of academic literature out there that the best inversion to consider isn't any of those that I just mentioned. That it's the difference actually between the 10-year and the 3-month maturity. That this does not give off the false positives or head fakes that maybe the 10-year minus the 2-year yield would. So the joke is, of course, that the 10-year to 2-year inversion has predicted 11 of the last past 8 recessions because of the head fakes. And as we can see, though, that the 3-month rate here on May 31st was above the 10-year rate at the start of summer and stayed that way for a good part of the summer. So moving away from the yield curve, we take a look at S&P 500 earnings. And earnings estimates traditionally follow a pattern where they are high in aggregate when they're first released, when S&P starts releasing these estimates at a certain point in time, and then they come down as analysts reassess individual company prospects. And we're seeing that, of course, right now with calendar year 2020, when these estimates started getting published, they were at 192. Recently, they were at 178, and actually they're actually closer to 177 now. And this is the normal pattern that we usually see. 2019 was a little bit different. It's gone from 160 to 162. And you can see in 2018 that they actually ended up higher. And that was the effect, of course, of the Tax Cuts and Jobs Act. And now we see this usual pattern coming on of them declining as the year goes, as the year keeps going, and analysts write down these estimates as they get results and commentary from management. We take a look at what might be causing this. So in 2019, we still do see a good slope downward slope for most of the year, even as the market marched upwards. And that was led by declines in certain cyclical industries that would most be hurt by that trade war that dominated headlines for the first half of the year. So a trade war, of course, would mean slowing economic activity, not only in the U.S., but globally. So industrials, materials, think of steel stocks, and chemical stocks, and of course, energy, along with tech sector names, specifically within the semiconductor and tech hardware space. All these have been hurt or cited at one point or another in the media as being an outsized risk because of this particular trade war. And those estimates were being written down as the year went along. So what we have to do in 2019 and 2020 is to say, where is earnings growth going to be coming from? And we touched a little bit on how the second part of 2019's rally really came from investors rediscovering cyclicals after the rhetoric surrounding the trade war was tamped down, probably around Labor Day in the late summer. So what we take a look at is what analysts are currently expecting earnings growth to come from. Which particular sectors, which particular companies are best going to benefit from, say, this trade deal being signed today in Washington, D.C. And what we could see is that 2019, overall in aggregate for the S&P 500, we're just predicting 1.4% earnings growth. And that's because some earnings losses within the energy industry, the materials industry, and the industrials industry versus relatively pedestrian growth rates for a number of others, with really healthcare being the leader in terms of earnings growth in 2019. When we take a look at 2020 earnings growth, we're seeing sort of the reverse of that, as analysts become a little bit more bullish on the prospects for energy companies, say, of course, as energy prices go up, for industrials, as not only do transports have more goods to ship, both here but also overseas, the capital goods that we sell overseas, also those orders start to pick back up, but also the materials, chemical makers and steel makers are going to see better prices and better volumes here. So overall, we see S&P 500 earnings estimates rise up to 9.6%. Now, the other side of this coin are the traditional defensive sectors. And, while their earnings growth is going to be positive, just like it was last year, it's going to be below that market average. And given the lofty valuation on some of these names and some of these sectors, part of that having to come from a defensive versus cyclicals rally that was in the first part of the year, we could see investors continue to move toward cyclicals, especially as those valuations appear attractive on a growth-adjusted basis. So it actually might be time for cyclicals to take a lead here. And this is a very interesting chart that we have here. And this is just taking a look at the returns of cyclicals versus defensive stocks here. And when we talk about defensive stocks, Traditionally, we're talking about staples, real estate, utilities, and healthcare. And when we're talking about cyclicals, we're talking about industrials, energy, materials, and tech. Some also throw financials in there as well. In 2019, the market returns really could have been divided into two stages here, as we can see. The first one, as we've talked about, the defensives really sort of carried the market through Labor Day. Markets were anticipating each of those particular Fed rate cuts, and people were continuing going to some of these stocks that were considered as good places to have nice dividends and relatively safe, low volatile returns. Phase two, once we saw the trade deal go through in terms of the tariffs were put on, but we started seeing sort of a thawing in terms of the idea that maybe the next tariffs, what round of tariffs won't be put on. That's really started on September 1st with that $300 billion worth of imported tariffs, and then rhetoric really started going down from there. We start seeing the cyclicals start to outperform, and we received one more Fed rate cut at the time, and we're really seeing, of course, there, as you can see in the chart, that cyclicals, because of that upward tilt, that shows that cyclicals are starting to outperform finally after a long period of really defensive underperformance there. So we can see that over the long term that the defensive trade's done well, but the market may be signaling something that we do see in a lot of late market cycles, and that is a preference for economically sensitive names. So one other area that we were talking about was small caps, and this is, a case here that maybe small caps are being set up to outperform in 2020 here. Right now, if we take a look at those current forward PEs, the S&P 600, which is the small cap index, has a similar valuation to its large and mid cap peers. But unlike those two, it's actually trading below its 10-year average forward PE. And if we take a look at that projected EPS growth rate there, it has a much higher one. This makes it a relatively attractive part of the market in terms of investment when you take a look at it from this particular vantage point. One other thing that could help is that U.S. small cap stocks have really underperformed their larger cap peers in the last 15 months. And that's something that, once again, they could be set up for a rebound on that relative basis. So in the recent past, one relationship that a lot of economists have noticed, a lot of financial observers have noticed, is that U.S. small cap performance is really closely correlated to U.S. manufacturing environment. These smaller companies, these smaller cap companies do not usually have the overseas sales that larger companies do. They're just not at that particular point in their company life cycle. If we see a manufacturing rebound within the U.S., small caps could outperform. And there's evidence in certain surveys here that the U.S. domestic manufacturing demand is doing better than what is widely understood. The surveys that grab headlines usually take in a lot of foreign demand and not necessarily domestic demand. And so these small caps, once again, the demand for their goods might actually be a little bit understated here.
Hey, Christian, this is Josh. Just to piggyback on that for a second. So when we talk about manufacturing demand within the U.S., I mean, it's interesting because I have seen several articles out there that talk about a manufacturing recession or a slowdown in certain swing states, because obviously that's a big issue for the 2020 U.S. elections, which I know you're going to be talking about in a little bit. But that idea of manufacturing not really being in a slowdown or a recession, that's something I just want to maybe have you elaborate on a little bit. You're saying we shouldn't necessarily give as much credence to those headlines. Is that right?
Well, there are certain surveys that you can take a look at that do show that manufacturing orders are in a recession, or that they've just sort of fallen below expansionary levels. But a lot of those have to do, and what they do is they take a look at, they're overshadowed by some of these larger companies here. What we're seeing is that, in some domestic oriented firms, that their business is doing pretty strong here. And there's been a little bit of press of that lately, is that those surveys that are more focused on domestic manufacturing demand, and especially when you still take a look at, say, the Fed's Beige Book, where you get the anecdotes from manufacturers and other market participants, the demand still looks pretty good in a number of areas. And because of that, maybe we're going to see some of these smaller companies outperform. Maybe these larger companies that have these overseas markets, these overseas orders starting to wane, maybe they underperform. Maybe they're the ones that are going to be in trouble. But those that are domestically focused, their business appears to be doing okay for now.
Got it. Okay, so we shouldn't assume that, because of all the trade war talk and the tariff regime that's kind of been put in place, that all supply chains are internationalized. That may not necessarily be the case.
Correct. And this is something that you have to take a look at it, on a company by industry basis as well. So obviously the international orders get the headlines, but there's always another story lying underneath that.
Thank you.
So one area that we can take a look at and say that, perhaps manufacturing, perhaps jobs are still at a relatively strong demand here, is the unemployment rate. And the good news is that the unemployment rate is at multi-decade lows, a fact that has been touted by economists and politicians alike. And it's even lower than it was in those days in the late 1990s. The U6, which some consider the true rate of unemployment, because it also takes into account those that are working part-time but want full-time work, it's really also at its multi-decade lows. So the flip side of this is that when the rate gets this low, it's really hard for it to imagine it getting much lower. So right now we're talking about us being at full employment. That is, everybody that is looking for a job or wants a job pretty much has a job here. And when this happens, usually we start seeing some wage pressures come in as companies bid on good workers, or that they have to bid on getting people back into the marketplace. And of course, when you have to pay higher wages, this drives down corporate profit margins. And when you start taking a look at the market, and when you start taking a look at returns and profits, this is something to consider. Moving on to the Federal Reserve, they're ones that are also taking a look at this. And for them, even though we are at full unemployment, they are always taking a look at other areas of data as well. The unemployment rate is actually considered a coincident or even a lagging indicator of an economy's strength by a lot of market observers. So it seemed like we spent a good part of 2019, especially the early part, obsessing over the present and future moves of the Federal Reserve. And we weren't the only ones, with everyone from economists to the president weighing in on the level and the direction of interest rates. And this is for good reason. These rates, they affect everything from the rates that consumers pay when financing large purchases to the strength of the U.S. dollar, and thus the competitiveness of U.S. goods and services in the overseas market, once again going back to those overseas factory orders. So the Fed cut this rate 3 times during 2019 to 1.75%. We have a long-term chart here that you can see it's still way below where it was in 2006, 2007, but we had been moving markedly higher since they first started raising rates in 2015. So the Fed did cut this 3 times to 1.75%, and this is really starting to take a look as more of a mid-cycle adjustment, and that's a lowering of rates to keep the economic expansion going for a little bit while longer as a way to brace against downside risks, be they domestic or global, and you can make an argument that there are some of those on both of those venues. And Fed Chair Powell even used that language, calling it a mid-cycle adjustment, in his July 31st statement. But perhaps more important than that headline Fed funds rate is that the Federal Reserve is starting to expand its balance sheet again. This fall, in response to, in part to some of the issues in the overnight lending market in September, the Fed went out buying Treasury bills, and we can see this on this chart here that the actual assets of all Federal Reserve banks are starting to trend higher again after we start seeing that sell-off, them selling off some of those and letting them run off, these assets run off over the last couple of years. Now, Federal Reserve Chair Powell insisted that this isn't quantitative easing, as you can see as in 2012, as the Fed started really building up its balance sheet. That was the height of the quantitative easing regime. So whatever they want to call it, this injection of liquidity into the system makes the Fed's actions all the more accommodative on top of those rate cuts that we just saw. Combine that with the accommodative stance by the ECB, the European Central Bank, as well as Japan, and this is seen as sort of a positive for stock prices, not only in the U.S., but worldwide.
Hey, Christian, this is Josh again. So just real quick, I mean, if we were kind of assigning weightings or approximate weightings and percentages to what's really accounting for some of the positive performance we've seen in equities of late and possibly what we'll see going forward, how much of this is really kind of valuations, earning expectations, and how much of it really is just kind of the Fed goosing markets? I mean, with this excess liquidity, I mean, all that money sloshing around's got to go somewhere. People are looking for the best return. It ends up in stocks, finding a home there. I mean, the old adage about not fighting the Fed. I mean, how much does that really apply here? Are they really the only game in town?
They aren't the only game in town, but this is a question that we're all still trying to answer here. One thing that we could take a look at is when you take a look at all risk assets in 2019, they all posted above average returns, which tells you that liquidity is entering the marketplace, and maybe it's helping these returns on a number of particular securities and asset classes, not just U.S. stocks, not just international stocks. Now, the key here is, of course, that Fed expectations and expectations of which way the Fed is going to move is built into valuations. This is something that a lot of people, of course, put into their models for PEs, but also whether to favor certain sectors or certain markets over the other. If the U.S. is going to have stronger rates, of course, that means a stronger dollar. What does that mean for U.S. manufacturing? What does that mean for U.S. services? And overall, what does that mean for capital inflows into a country? And these are all things that you have to consider with the Fed and what they do when they make these particular moves. So I think that the moves by the Fed, especially the raising of, once again, taking the balance sheet higher, is something that isn't exactly fully appreciated yet by the market in terms of its effect. The Fed funds rate, we see that all over the headlines, but as I said, that balance sheet, that's an interesting phenomenon as well.
Okay, thanks. Yeah, because I know Jay Powell and others have kind of downplayed the idea that it is, stimulative, and it sort of looks like inside baseball talking about stabilizing repo markets and things like that. And those are the types of headlines one would, I think, a layperson, Joe Average, would ordinarily overlook. But I mean, clearly there is a stimulative sort of effect, and a lot of people are calling it the next quantitative easing, which clearly led to a run up in risk assets, in recent years too. So it's something I'm appreciative that you pointed out.
Well, thank you. And this is some story that's really something to watch for in 2020, both the direction of the balance sheet, but also the expectations of where Fed fund rates are going to go. So,
thanks.
Well, yeah, no problem. So when we take a look at where we are in this economic recovery from the great financial crisis, we are still really currently in that recovery because it is the longest uninterrupted recovery in the post-World War II era. We reached that mark, I believe it was July this year. We haven't had a recession since the great financial crisis. So we've covered the possible reasons for why we've had such a long recovery before, but also such a relatively slow one here. And that is what we can see here in terms of the cumulative U.S. GDP growth. It's been longer, but you can see we have not recovered in terms of production, what we usually do in a recovery. That line is way below everything else that we've seen in terms of recoveries, no matter what the length of quarters it has been. So, we can say this is for a number of reasons why. Recoveries from financial crises are different in regards to terms and tenor. Tightness of credit may have inhibited growth in the early part of the cycle, if you remember. And there's also been an uneven distribution of rewards than what we've seen in past recoveries. But still, due to the resilience of this economic recovery, not a lot of market observers are saying a recession is imminent in 2020. Could be more of a low, slow, but steady economic growth, which we've gotten used to here over the last decade. So then we'll take a look at what the Fed is forecasting. And I took this from the minutes that were attached of the December Fed meeting. And it appears that they believe that more of the same is indeed in store in terms of employment, economic growth. The Fed's also sticking to that 2% inflation growth target, a stance that's been a little bit controversial over the last couple of years, as inflation really has never met that over the last couple of years, as well as the idea is the Fed even measuring inflation correctly. Most interesting may be the projection of the Fed funds rate. The rate and the range of projections isn't necessarily shown here within the report. The range of projections within that report showed that there was at least one participant not forecasting a rate move until 2022. So that, as we can see, that Fed funds rate is going up in terms of the average projection. Some believe that it's just going to be this way, lower for longer. And that is interesting to take a look at. So with that.
Yep, thanks, Christian. So it looks like, as you've clearly stated, there are several things going right for markets, lots of things supporting them going into 2020. And we'd now like for you to turn to some of the things that are perhaps giving you cause for concern going forward.
Well, yeah, so there are a number of them. We talked a little bit about valuations. And one good question as this market rally enters its next phase is where the demand for stock purchases have come from. And we've heard over and over again that this is the most hated market rally ever, and that the market, despite this amazing returns that it's posted, has not really captured the public's imagination. We're not seeing magazine covers or, huge articles on CNN.com about amazing market returns. And that this is, in some parts, correct. Taking a look at this chart from the market bottom of 2009, corporations have been the main source of market demand. They're buying back their own shares. Households, seen here as that blue line, are net sellers of shares here, as well as some other domestic buyers. They're selling their equity exposure as well. And this makes sense from a corporate finance theory. If companies think that their share price is undervalued and they can borrow at ultra low interest rates, which we've been at for the better part of this decade, it actually might be in the best interest of their shareholders to buy back shares. And we're seeing that kind of logic play out here through most of 2010 through 2020. The question is, of course, if they think their shares are fully valued, are these rates of buybacks going to continue? And we're seeing some signs, of course, that corporate buybacks are starting to wane here. One other thing to consider, we had talked a little bit about manufacturing surveys and factory orders. And I think this is what you were talking about, Josh, here, the U.S. manufacturing ISM PMI. And we can see that this is below 50 again. Remember, with these readings, anything below 50 is considered in contraction territory. And it wasn't too long ago, really at the start of the year, that U.S. manufacturing appeared to be roaring, at least according to this survey, putting up readings close to 60. So in August, this manufacturing PMI slipped below 50 and it's continued to decline to a 47.2 level. And that's really level consistent that we saw with the profit recession in the mid part of last decade, when S&P 500 profits actually went down year over year for a few quarters. While manufacturing is now really only a little under 12% of GDP, it employs 8.5% of the workforce, and it's still really a good early barometer of economic conditions. The 10-year Treasury has a high correlation over the last 10 years with this, with higher interest rates, of course, being indicative of improving conditions. So there could be a couple reasons for this. We talked about the Federal Reserve earlier. U.S. interest rates are higher than the rest of the developed world. Think of the negative rates that we see on a lot of European and Japanese debt. This supports the U.S. dollar, making it strong. A strong U.S. dollar impedes the competitiveness of U.S.-made goods in the global marketplace. When we also took a look at the unemployment rate, and we did warn that unemployment rate is considered by some to be a lagging indicator. But one thing that we also take a look at, and we talked a little bit about this last year, is the importance of the U.S. job openings total. And this is released monthly by the Bureau of Labor Statistics. And what we're seeing here, as it falls below that black line, is that we're starting to see a year-over-year decline in the total job openings for non-farm payrolls. The actual number of job openings is starting to go down, as opposed to the mid-teen % rises we were seeing just a year ago. So if employers aren't posting jobs, what does this mean for wage growth? And in terms of, and also, what does it mean for future economic growth? Not only just the unemployment rate. Of course, one thing that we were all waiting for here is wage growth. As we hit full employment, are we finally going to see people starting to get paid more, and does that money go into the economy? And there was a sign for a while, and still is, that finally low wage earners were starting to get these raises, and that money was stimulating economic growth here within the U.S. And for a better part of last decade, wages really weren't keeping up with inflation. As we hit full employment, wage growth did start to accelerate as employers had to entice workers from other firms or back into the workforce. And this increase in average hourly earnings is highly correlated with improving consumer sentiment. It takes about 2 years for people to get used to or even more secure in their larger paychecks and the ability for them to take on more expenses or more consumption with that. If we're starting to see a stall in these wage gains, as it looks like we have been in 2019, going into 2020, this could also be a cause of concern for the broader equity markets. And really, those income gains matter as the consumer continues to deal with the reality of real incomes falling over time in really a number of industries. People feel like they need to catch up from years of wage stagnation. That's something you might have heard from others, that they really feel like they can't keep up with their expenses, or that they haven't gotten a raise in a few years. And we've touched a little bit on economic equality in the presentation in years before, and we're going to do so again here. And this is really an interesting chart from a working paper McKinsey and Company did on this issue in May 2019. You could go to their website and download it. It's a good 1 hour read or so. And what we can see from this chart is that labor has received, in terms of the gross value added due to economic activity and productivity, what they have really have received has declined during what could be characterized as the tech productivity boom. While it's been trending lower from decades, from that 66% that we saw in 1950, the acceleration's really been stark since about 2000, before finding really a floor here over the last 5 years or so. But still, this phenomenon has really a far-reaching effect on a number of fronts, in terms of politics, people's risk tolerance in terms of making large purchases or projecting out their income for future years, consumer behavior, and with consumer consumption still being 68% of GDP, an important economic driver in terms of future growth, not only this year for GDP, but beyond. However, this leads us, of course, nicely into our next section.
And as we do that in these final 10 minutes, Christian, I can talk to you about this all day as far as economic inequality is concerned. Just want to be aware of the fact that we've got a few more slides to go for our attendees, and hopefully we'll get to some questions as well. So sorry to jump in. Just wanted to throw that out there.
Yeah, no problem. So other things to watch for here, and just to go into this, first and foremost on everybody's mind is the 2020 U.S. elections, and what this could mean for investors on several fronts. There's a populist energy on both sides of the aisle. Think of the Democratic debates as well as the rhetoric out of the Republicans as well. Investors need to consider how it may affect what they own. Already, candidates in primaries are making headlines on a number of industries that they pledge they'll reform if they get in the office. For some, it's the financial sector. Think banks, building on the regulatory framework that was placed last decade, like the Volcker rule. Other candidates have discussed the power and thus responsibility of a number of social media providers, especially as that relates to if they're just content aggregators or actually publishers that can be held liable. Third front, which may get the most debate, is the cost of healthcare and the mechanism in place that should pay for it. Everything from drug prices to truth and medical billing to insurance marketplace structure, all of this could be affected. Taxation policy could be discussed on the campaign trail. Will we expand or roll back certain parts of the Tax Cut Act of 2017? And really, do we need another tax cut to stimulate the economy? So all of these are areas that we might be seeing a little bit more debate on here as 2020 goes along. The China trade deal is another area, of course, that is something that we're going to have to keep an eye on. We did sign phase 1 today, it appears, as I was coming in here for the webinar. But the next thing, of course, with the trade deal is what's the next step. So phase 1, which was announced in October and really was part of this great rally that we've seen of late, hit some of the low-hanging fruit. We see some relief of U.S. tariffs on Chinese goods. China is going to buy some agricultural products. Tariffs have really skyrocketed over a 12-month period from single digits to 21%. Phase 2 is going to be a little bit more difficult here. And what we're going to see is intellectual property and violations, as well as forced tech transfers if you go into a joint venture in China. That's going to be covered, as well as Chinese subsidy of industries, be it chemical, steel, financial. Those are things the U.S. wants addressed. There's different ways for the U.S. to do this besides tariffs. One of it, and we've already seen this, is a supply chain shift. U.S. trade with Vietnam actually went up 34% year over year as some supply chains shifted. New laws passed within the U.S. in regards to tech transfer or targeting certain companies. And of course, we can still always go through the World Trade Organization as a mechanism to try to get some trade relief. The next thing for us to consider is that the yield curve did invert. So when is the next recession? Using a 50-day moving average of that 10-year to 3-month Treasuries, this has been a really reliable indicator with no false positives. And using this, what we see is that on average, this means that the recession would actually start in May 2020, although there's almost really a year-wide range in that data. If recessions sort of follow more of a recent pattern, we'd probably be looking at 2021 before we would see a recession. And just to remember that recessions are discovered after the fact. They aren't necessarily declared. We find them after the fact here, after going through all the economic research. So the other area that we've touched on in the past that takes a little bit more is when will value outpace growth? We said growth has been in a super cycle here over value through most of the decade. So one way to take a look at this is how things looked at 2010, growth versus value trade, but also the U.S. versus emerging markets trade. There's long-term structural reasons for each to work through the past decade, dealing everything from low growth environment to the action of the U.S. dollar. So what I'm highlighting with this chart is that these investment regimes can last a long time, but they often do reverse. And as we can see here with this prior decade's returns, value has held pace with growth in the back half of 2019, and emerging market equities also had some outperformance relative to the U.S. in recent months. But as we saw in 2000, growth did underperform value as opposed to 2010s, and the same with the U.S. versus EM. So these things do reverse eventually. What we've seen, markets are mean reverting. And that takes us back to valuations. And we've talked about a little bit about valuations are elevated. And what we do is take a look at probably one of the best long-term valuation measures, and that's that Shiller PE. And what we're doing here is we're taking a look at it versus these 10-year forward returns. AllianceBernstein released this chart, and it shows that when the cyclically adjusted Shiller PE is at these elevated levels, it usually means that 10-year forward returns come down to about a 5% annualized level. Now, remember what we saw at the start of this webinar is that over the 2010s, we were seeing a 13.6% total return. So these would be markedly lower returns than what we've been used to over the last decade or so when we have a Shiller PE at this particular high level that we have right now. And the process of getting these lower returns might be gradual and lumpy, but this relationship between these two is awfully compelling.
Hey, Christian, this is Josh. Just in the last couple minutes we have here, we're bumping up against the top of the hour. I think I'm going to call an audible here and just have that last slide of what you've outlined of things to watch for in 2020 on the screen as we maybe take a couple questions. So if those who are in attendance right now have questions, feel free to send those our way. We will field those. And if you need something in great detail, we can obviously respond offline, and feel free to contact us. And I'm going to kick things off with maybe cherry picking a couple from that list. You mentioned in passing that phase one of that trade deal was signed earlier today. Maybe just if you could, for a moment, elaborate on what that might mean for markets in general, but for the Azzad Ethical Fund in particular.
Well, sure. So when we take a look at what that particular trade deal means, it's seen as a boon for industrials and some of the other cyclical areas of the market here. So one thing to consider would be, say, we're talking about farmers that are going to be able to sell their soybeans back into the Chinese market. Well, that could spur more investment by those farmers into, say, farm machines. That would be good for tractor makers and other industrials. We would see that across all sorts of capital goods that the U.S. does still sell into China. We do sell things back to China, and we would see those orders once again pick up. We would also see orders pick up across probably the rest of the globe as people start, not only within China, but also Japan and Europe, also start getting a little bit more confident in their future orders that they can sell to their particular customers. So what we would see is, higher sales projections and higher profit projections for the industrial sector and the information technology sector, which are both areas that the Azzad Ethical Fund is overweight at the moment, specifically the semiconductors.
All right, excellent. Thank you. In light of time, I think we are going to have to call it. So if folks have other questions, please reach out to us. We're happy to pass those along to Christian if necessary, or answer those ourselves. We want to thank everybody for your time and call your attention to the material and information on your screen right now. Of course, I also want to thank Christian for being with us today. Please visit our website, azzadfunds.com, where you can download and read your copy of the prospectus for the Azzad Ethical Fund. It contains information about the fund's risks, expenses, and investment strategy. And while you're on that website, you can also sign up to receive our monthly e-newsletter to get more information about our products and services. Finally, be sure to follow us on Twitter and like our Facebook page. And as I mentioned at the top of the presentation today, a recorded version will be posted to our YouTube channel, youtube.com/Azzad Funds, and on our website very soon. So be sure to take a look. Thank you for your time. And thank you again, Christian. Always appreciate the contribution. Great stuff.
Always my pleasure, Josh. Thank you.
Thanks. Have a great afternoon.